So are we in a recession? Have we been in a recession? What is a recession anyway? I don't even know who to believe. So I had to do some digging, and this is what I found. A recession is a significant decline in economic activity for 3 or more months. So chief economists declared that the nation is in a recession when the GDP, the gross domestic product, goes down. That also says that when jobs get cut and jobs go down and no more new jobs and prices start falling and everything starts going down, no one's purchasing, prices have to come down. At that point, we're in a recession. So my question to you is, have you seen prices go down? Yeah, me neither. What about mass layoffs? Now, we've seen layoffs. We've seen companies like Amazon make cutbacks, but also we've seen where Amazon geared up big time during the pandemic, mainly because people couldn't go outside. You couldn't go outside and shop. So what do? You buy online. So what does Amazon do? Amazon hires up. You have to hire up to take care of that demand. Now, as the pandemic goes away and everyone gets back to normal, people get back to an offline way of purchasing, meaning they're getting back in stores, they're going back in department stores, they're making those purchases where they're touching and feeling things as opposed to just ordering online. As a result, Amazon's purchases go down. As a result, what do they have to do? They have to make cutback in jobs because they don't have the surplus of people purchasing through Amazon like they did during the pandemic. So take Salesforce, for example. They're a consumer resource management software company, and the CEO sent out a letter to employees, and he admitted that we hired a little fat. We got a little bit too heavy on the employee side. As a result, they're talking about cutting 10% of their jobs. So what about BlackRock? Most people have heard that name and I think, well, BlackRock, what is that? Those are the people that are buying all these houses, right? Well, they're an asset management company, and they said that they're going to be cutting back about 3% of their jobs. But what people need to know is that over the last 2 years, they increased their job force by 22%. They increased their job force by 22% literally over the last 2.5 years. Now they're making a slight adjustment downward, just 3%. Now, according to the National Bureau of Economic Research, they say it has to be a deep, pervasive dive, consistent 3 months or longer to be considered a recession. But what causes a recession anyway? Economists focus on drastic changes in one or more social or economic activities. So for example, a prolonged surge in oil prices can cause a huge ripple effect and a recession across the entire nation. So let's take a look back at 2008. In 2008, the cost of a barrel of crude oil was a record $147 a barrel. It's never been higher ever in the history of the United States than $147 a barrel. Now, to put that in perspective, today, 2023, the cost of a barrel of crude oil is $81 a barrel. So think about that. 15 years ago, the cost of a barrel of oil when we had the Great Recession was in 2008. It was $147 a barrel. Today it's $81 a barrel. Now you have to look, that was 15 years ago, and a dozen eggs was $2.16, and a gallon of milk wasn't $5 a gallon like it is today. As a result of that $147 a barrel for crude oil, gas prices hit a record high, which still holds to this day, at an average of $5.37 for a gallon of gas in 2008. So in 2004, 5, 6, and 7, the economy was rolling great. It was easier to purchase a house. People were buying houses, unfortunately, with interest-only loans, but they could purchase a house with a 580 credit score. As a result, the economy boomed. But then as we seen crude oil prices at $147 a barrel, the job market came to a screeching halt. You see, in 2008, more than 2.6 million jobs were cut, and 11 million people in the United States were out of a job. As a result, people fell behind in their mortgage payments, and as you know, it caused a bit of a shift in the economy. Mortgage defaults hit a record high, foreclosures hit a record high, and with that, the economy receded, thus the recession. As a result, people rapidly slowed down the rate that they were buying and investing. As a result, caused a stock market crash in 2008. But you can't just blame that on the spending and investing without looking into the deregulation of the financial industry that went on during that time. This is what allowed the banks to engage in hedge fund trading with derivatives. So then the banks demanded more mortgages to support the profitable sale of these derivatives. So they created interest-only loans and subprime lending. And yeah, you guessed it, the interest payment on the interest-only loans went up, gas prices went up, oil prices hit the roof. As a result, layoffs, cutbacks, and a recession. Now, as we speak of a recession, we can't help but look back 15 years ago to 2008 and think, what was different then than in the economy today in 2023? So there's 3 things. One, Crude oil prices, $147 a barrel. The second thing is, for 3 years, you had record high homes on the market. Literally in 2007, there were 3.7 million homes on the market. And then added to that, there were 2.6 million jobs cut in 2008. So oil's not as high. It's $81 a barrel today. We haven't seen all the job cuts, but how many homes are on the market? So we had 3.7 million homes on the market in 2008. Today in 2023, it's just over 1 million homes on the market. So you can see we actually have a shortage of homes available to purchase for the buyers that want to purchase homes. And look, you have to know people are staying in their homes longer. They got a really good interest rate, so they're kind of sitting still, and it's pretty good because they got a 3.5% to 4% interest rate. You have to also look at the surge in millennial home buyers and the rate that they're purchasing houses. And you can't forget about investors, whether it be a seasoned investor, a new investor, a small investor, or a large corporate investor. They're purchasing property still at a pretty high rate. So we don't have crazy high oil prices. We don't have huge layoffs, and the prices of things don't seem to be falling. I mean, was it $6 for a dozen eggs? But look, the fact is we're a big country. We're 334 million people, acres and acres of land, cities everywhere. You'd be foolish not to look at and think there's got to be a city where prices are coming down, where there's a shift, there's an adjustment, and there is. But look, a lot of the cities that we're seeing prices come down are typically the cities where we see the highest prices or the surge in those prices, like San Diego, San Francisco, Los Angeles, Boston, New York. Those cities had huge surges in home prices going up. And those typically, and they are, the first to start to come back down. But I must say, what I'm seeing here in the trenches still actively brokering and selling real estate every day is we're seeing builders not so much come down on the prices as they are offering incentives such as upgraded hardwood floors, closing costs. They're offering to buy points down. So your rate, instead of it being 6.3, you can purchase a new house and have your rate be 4.7 or 5% because they're buying your rate down. They're doing these types of incentives. The last thing they really want to do is come down on the prices of the houses. But if it comes down to it, they'll have to. So when it comes down to it, when we really look at it, gas prices are stable, home prices are stable, there's not massive layoffs, and stuff's still high. I don't know if it's high in your neck of the woods, but it's certainly high in my neck of the woods. Are we and have we seen a shift in the economy? Absolutely, especially with big ticket items. You got to consider they doubled the interest rates. They went from 3 to 6% in a period of 6 months. And in doing so, it pulled the reins back big time on large ticket items, boats, motorhomes, investment property, purchasing single family homes. It was just like shell shock because they did it so fast. So look, the good news is they dropped the interest rates 10 basis points. As a result, the interest rates today, 6.15%. That's on a 30-year fixed note. On a 15-year fixed, it's 5.75%. So what's my prediction in the nearly 3 decades of the real estate business? They've lowered the rates. As a result, you'll see a surge of people purchasing houses. They'll raise the rates. You'll see a little bit of a surge, but you'll see a slowdown. Then they'll lower the rates. I think they're going to do that for the entire 2023 year. I think they're going to go up and go down and go up and go down. I don't think we're going to see interest rates, mortgage rates over 7.5% during this 20 and 23 year. So until next time, have fun and no worries.